The ISM Services employment component was pretty remarkably weak. It dropped almost 7.4 points sequentially, and the reading level came in at 43.3. That is an unbelievably weak print. To put that into context, if you look back at that series over the last quarter century, last 25 years, there have only been two periods in that whole 25-year time frame when the ISM Services employment number has been as low as it was reported to be on Friday. And that was the fall of 2008 and April of 2020. In fact, if you went back and looked at the entire dot-com recession, which I think is kind of remarkable because obviously that impacted the services industry tremendously by way of the tech sector, it never, over the entire stretch of that recession, never got down to a level that was as low as what we saw on Friday. That is a really, really weak print. Obviously, the overall ISM Services number slowed significantly alongside the new orders component quite dramatically, but the employment component was just an absolute eye-popping number. And then right on cue, I won't mention who, but the world's largest asset manager, you can probably figure out who that is. They just announced layoffs this morning. Yeah, cutting about 3% of the workforce on the heels of obviously, 23 that was pretty good if you were, predominantly a long-only manager. So,
Wall Street didn't even talk about it. I mean, it's like, bonds traded on it because you got basically the 10-year yield post the jobs report, which for a tourist headline number was rainbows and puppy dogs, right? But we reviewed that, and then you get up in the range for 06 service report comes out and bond yields pull back in textbook style. I think the main reason why they didn't go down faster than that is one, what I just said, which is Wall Street conveniently didn't discuss the internals of the ISM Services report. They'll do that when it's bullish, not when it's bearish. And two, you got the CPI report on Thursday, right? So, as a reminder, we don't have CPI with the 2 in front of it. And, to get in the eyes of a tourist, they think it's only about inflation, right? In the eyes of Hedgeye's, it's always about growth and inflation. So we'll walk through tomorrow in gruesome detail why the growth component is, and the employment component, which Steiner just highlighted. Again, we were forecasting this. It got worse than what we thought it would in December. Don't forget that January and February is going to be worse than December from a monthly quad perspective. So I think that, we'll talk about, we can only say the same thing so many different ways every day, but we get new data a lot of the time, so we can say it with that at least. And that's what I have to say about that.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.